If you're here to learn about the FHA guidelines summarized, you're in the right place. I'm going to give you lots of details, but I also don't want your eyes to roll into the back of your head. So come along, let's talk FHA. First of all, here's some things to whet your appetite about FHA. They are more lenient than other loans. So if you have a little credit blemish, something of that sort, you're in the right place. So they're also not just for first-time home buyers. They are typically better for lower to mid credit scores, and you really don't want to keep them for the long term. And I'm going to tell you why as we move along. But if you have a 580 credit score or higher, you can get an FHA loan with 3.5% down. And if you have a 500 to a 579, then you're going to need 10% to put down. Before we go much further, let me introduce myself. My name is Linda Shinpaul. I'm a licensed loan originator powered by Edge Home Finance Corporation, and we are the #1 national mortgage broker in the U.S. Let's go over some pros and cons of FHA loans. Pros, they're easy to qualify for. They have a low down payment. There are rehab options. We'll get to that. You can buy a 1 to 4 investment property. I'm going to use investment property with air quotes, but I'll show you that. Cons, you have mortgage insurance times 2. FHA loans have a lower loan limit than a conventional loan. There are much tighter appraisal requirements, and sellers sometimes assume that there's problems. When they see an FHA loan coming their way, and I dare say that if they have a great realtor, they shouldn't feel this way because the realtor should understand what a great tool FHA loans are. But some realtors and therefore some sellers think that because you have an FHA loan that you have bad credit or it's a questionable loan with the tighter appraisal requirements. Maybe their house isn't going to pass inspections. So there's a little bit of that. But I'll tell you, I'm on your side. When I'm working with my clients, when they make an offer, I am calling the buying agent and the listing agent and introducing myself and telling them what wonderful clients you've been and how responsive and attentive you've been to all my requests, and that you're fully pre-approved and I don't expect any issues. So there are ways to get around that, but still, there is a little bit of stigma out there. It really shouldn't be. What does FHA stand for? It is not the First Time Homebuyers Association, and it has nothing to do with first-time homebuyers in the name itself. FHA stands for the Federal Housing Administration, and it is a part of HUD, the U.S. Department of Housing and Urban Development. The goal for FHA loans was to make home ownership more widely available to consumers, to give a little more leniency in some of those credit terms, to have a smaller down payment with the 3.5%. All right. FHA actually insures the loans. They don't make the loans. The lenders make the loans and approve the loans. So there you go. Now you know. If you need more help and you're listening to this video to try to figure out if you can be approved, if you even qualify for a home, I want you to know that I do have a free Smart Home Buyers Guide, and you can click the link in the video description or my channel description and get that. And then when you do, I'll stay in touch with you weekly with an email with just some tips and tricks. It takes a couple minutes of your time every week to look at what I send. You can also book a planning call with me. So don't feel like you have to dissect or decode all of this information in this video and figure it out yourself, because you don't. You want to take it in so you can be more knowledgeable and understand the topic better. But at the end of the day, this is what I do for a living, right? And so you want to be an informed consumer, but I do this for a living. So if you want to book a planning call with me, there's also a link in the description for that. And I just have 15-minute time blocks on my calendar. I know you're busy. And so grab 15 minutes, give me the high level of what's going on, and I'll either point you in a direction or say, hey, we need to spend a little more time talking about this. I'm thrilled that you're here watching my video, but at the end of the day, I want to help you personally, because you shouldn't have to go at this alone. All right, so let's come back to FHA. In 2024, the FHA loan limit for a 1-unit property, so single family residence, a condo, something like that, is $498,257. That's in most normal real estate markets. If you are in a high cost area, parts of California, Hawaii, some places like that, the FHA loan limit can be as high as $1,149,825. How about that? All right, so let's take a look at what your down payment would be if we're in a normal market, okay? if we're in a normal market and the loan amount is $498,257, that's the max loan limit in 2024, then with 3.5% down, you would bring $17,439. Now remember, you could put 3.5% down if you have a 580 credit score or higher. That's typically how this works, right? Now there are some other factors that go into play, and you have to make sure that you're fully pre-approved, but and you're not having to go a manual underwrite. But I don't want to throw all those terms at you. I want to just give you some broad terms for you to understand, because every loan situation is unique, and you may have some compensating factors and you may have some other things that are weighing against you. And I really, without looking at all of that, we can't be for sure. Okay. But this is to give you this is what the guidelines say. These are the overviews. So if you don't have that 580 credit score, then you're going to be looking at 10% down. So in the same situation, you go from $17,000 and change to $49,826. Still a great loan. 10% down is still a great down payment, but I want to show you the math on those. Now, don't forget about closing costs and prepaid items too. I'll make another video about that, but you are going to have lender fees, appraisal fees. I'm going to set up an escrow account for taxes and insurance. And so if you don't know what those things are, don't worry. I will make another video about it. And if we end up working together, I go through all of that in the very beginning. Okay, down payment sources. There's lots of places that you can bring that 3.5% or 10% from, right? Of course, you can bring your own money, right? Your personal funds. We would need to see bank statements or stock account. We would just need to see your bank statements for the last 2 months, and then we can verify that. You can also get gift funds from family or friends. Did you know you could get a gift from your employer? This all has to be documented. So don't go rounding this money up right away. Like, we got to talk first so we document it properly, but it's all possible. DPA, that stands for Down Payment Assistance Programs. Okay, these programs are very popular to talk about, but let me tell you a little bit about these, because I find that there are other ways to accomplish the end result most of the time, and DPAs tend to be a little bit unfavorable. So here's why. You often pay a higher rate for this down payment assistance program, right? They're actually giving you the 3.5% or the 10% down payment. And now you have gone into a real estate transaction with very little money out of your pocket, and you are a riskier buyer. The chances of you defaulting are higher than somebody who's putting more money out of their own pocket. And so lenders compensate for that risk with higher interest rates. So you're probably going to see a higher interest rate there. And you're also going to have higher fees on the loan, because that down payment assistance agency, some of it's out of the goodness of their heart. That's the intent of the program, but they have to make money. They can't give you money and not make money, right? It has to come from somewhere. So they're going to charge you a higher interest rate up front, but then they're going to charge some sort of admin fee for doing this for you. And then there's often strings attached. And what I mean by that is, I'm from Florida. Our local down payment assistance program was such that you had to live there for 5 years for that money to be completely free. So let's say you got $10,000 in down payment assistance from this particular down payment assistance program. Every year they would forgive 1/5 of the loan. So at a $10,000 loan, they would forgive $2,000 a year. After 5 years, all $10,000 was forgiven, and now it truly was down payment assistance money, and you don't owe them anything. There's also times where you have to live there a certain amount of time, and then they'll only forgive a portion of it, and you still have to pay some of it back. There are other aid programs where they are truly a second loan. So these things vary. There's so many flavors. It's like going into an ice cream shop. I mean, you can have all kinds of flavors of aid programs. But what I want you to know is that when you are basically coming to the closing table with very, very little money out of your pocket, right? You would have closing costs and prepaids, but your down payment's now taken care of. Do not expect that to be for free. There will be other fees. There will be a higher interest rate, and there are strings attached most of the time. Okay. And then last, you can get seller credits. With an FHA loan, the sellers can contribute up to 6% of the purchase price towards your closing costs and prepaids. And again, that's something that I would walk through with you, help you understand that. But also I would be communicating very clearly with your realtor about that, because he or she needs to know that when they're writing the offer. right? But lots of good options here. Types of properties. Okay, Linda, I'm kind of sold. I'm digging this whole FHA thing. I think I might fit in this box, but what can I buy with it? Well, we can buy the good old single family residence, right? Just a freestanding house. You can also buy a condo, but the HOA, the Homeowners Association, must be approved by FHA. And if it's not already approved, we can do what's called a spot approval, which means I can fill out all the paperwork for you, go to FHA and see if they'll bless it. You can buy a 2 to 4plex. So that means a duplex, a triplex, and a quadplex. We're going to talk a little bit more about how cool this is, but let me tell you, this is really cool. You can buy a fixer-upper house. There's something called an FHA 203K loan, and it is for rehabilitation. So again, I'm originally from Florida, and when we get some really bad hurricanes, sometimes houses get damaged severely. And sometimes you have a foundation and partial walls, or big holes in roofs and things like that. And the original owner just goes, you know what, I'm done. I'm just done. And so somebody with an FHA loan could go in there and say, well, I love this neighborhood. I love this area. And I really think this house could be amazing. Obviously, it just needs a lot of work. And so you can do a FHA 203K loan, buy the house in the condition that it's in, finance in all of those improvements. And then at the end of the day, you've got this amazingly rebuilt house with 3.5% out of pocket if you have a 580 score or higher. So it's a really good tool. People talk a lot about this. Not a lot of people use this 203K loan. And I'll tell you why. This is just kind of a fun fact. The reason is you have to get all of your bids from contractors in and committed to during the closing process. So you can't just go, hey, FHA, I think this is going to take $50,000 to fix up. So I'm buying it for $200,000. Let's add $50,000. I'll take a $250,000 loan. It's not like ordering, a hamburger with cheese and with all the works. It's not like that, right? You actually have to say, okay, I'm buying it for $200,000. Here's all the paperwork from the contractors of all the work that needs to be done. Add all of that together, and then that's how your loan goes through underwriting. And that's how the appraiser appraises it too, based upon your bids and what you plan to do. So you've got to be a little bit savvy and a little bit comfortable with making some bigger decisions in a pretty short time frame, but it is a great tool. You can also build a house. You can do a construction perm loan. So you have dirt, you have some floor plans, you have a builder that's approved with FHA. It's beautiful. And then mixed use properties. What that means is that maybe you're buying something that has, it's zoned residential and commercial. Maybe there's a little hair salon in the back, right? Or the person that lived there used the garage for a hair salon. So it's kind of zoned multi-purpose, or a dog groomer or something like that. Well, so long as you're using the property primarily as your primary residence, that is the first and intended use, then those mixed use properties can work under an FHA loan. So there you go. Housing standards. So FHA cares more about the condition of the property than a conventional loan per se. Okay. Remember, one of the first things I said to you was FHA is more lenient. It is more lenient on credit, but it's not lenient on the condition of the property, because it's being lenient on your credit. It's being lenient on your down payment. And so it wants to protect you and make sure that the house is in a livable condition and that you're not going to be strapped for cash and putting out all this money later for repairs, right? So what does that mean? FHA is looking at the safety, security, and soundness of the home. So safety. Is the house free of health and safety hazards? For example, no loose wiring or exposed electrical system. I'm good with that, right? Okay, security. Can the property be properly secured? We're talking entrances and windows. So like if there is a broken window in the house, it has to be fixed in order to pass the appraisal inspection for FHA. Okay, again, nothing major. I mean, you would want that anyhow, but if the house is in that kind of shape, just know that those things are going to have to be taken care of before closing. And then lastly, soundness. And here I just want you to think move-in condition, right? Is it structurally sound? No major damage to the exterior or the foundation or the roof. Now, this is for a normal FHA. When we get into the 203K, foundation needs to be sound, but the exterior and the roof, they can need repairs. That's what the 203K is for. All right. But we're just talking straight FHA right now. These are things that people always ask me about, and I end up talking with my clients about. So I wanted to put this here for you too, because this is just like the grassroots part. And this is what you need to know, right? So for FHA, the property must have working utilities, has to have electricity, heat, and clean water. It has to have heat, but they don't care so much about air conditioning. Isn't that something? Because you always turn a fan on and cool down for that. But heat, when you get super cold, I mean, that can be dire. So that's really interesting to note. Also, the house must have adequate ventilation in attics and crawl spaces. It needs to be free from wood-destroying insect infestations, termites. It needs to have safe and reasonable property access. We talked about that with the windows and the doors. It needs to meet all fire codes and applicable safety codes, and no soil contaminants or underground storage tanks. So these are some things that pop up all the time. So I wanted to make sure and tell you. But here's the thing. FHA doesn't require repairs for cosmetic reasons or a minor defect or deferred maintenance or normal wear and tear. Only if it's affecting safety, security, and soundness of the home does FHA voice their opinion. So like if it has orange shag carpet, or if the bathroom is really ugly, if the tile is dated, like if the countertops have scratches on them, if the hardwood floors are scratched, like that is typically cosmetic, minor defect, and deferred maintenance. Okay. So you could still buy something that's not in great shape, but it's all cosmetic that you maybe just want to update to your taste and to the times. Another question I get asked all the time is, Linda, why are there two types of mortgage insurance on an FHA loan? Okay, so we're shifting gears here to go into the payment. Let's get back to the money. All right, so FHA has what's called upfront mortgage insurance premium, which is 1.75% of the loan amount, and it gets added to the loan and it gets financed. Okay. Then it also has a monthly mortgage insurance premium that's part of your payment. Why do they break it in half? It's just more affordable that way. If they can take the mortgage insurance premium and charge you a portion of it up front and roll it into your loan amount and amortize it over 30 years, I mean, you're looking at 5, 10, 15, 20, it depends on your loan amount and your interest rate, whatever, but you're looking at a very minor increase to your monthly mortgage payment by doing it that way versus taking the whole amount, factoring it in every month into your payment. So that's why I believe that they do it this way, is again, to accomplish their goal, which is make homeownership more affordable to more people, right? So that's what they do. But the upfront mortgage insurance premium, again, it's 1.75% times the loan amount. You'll see it on your fee sheet. It gets added in and financed. So it's not extra cash out of your pocket. It's just a math calculation in how they roll that in. And then every month, you will also pay a small mortgage insurance premium. What is this mortgage insurance anyhow? It's important that you know because you're not going to escape it, not with FHA. Mortgage insurance protects the mortgage company in case you default. All right. And so because these loans require less money than some others that are available, they know that there's a little bit higher chance of default. And so you get to pay the insurance premium to protect the mortgage company in case you were to default. And with FHA, you're paying mortgage insurance for the life of the loan. So FHA is a great product to use when you want to get into a property. We're going to talk a little bit more about some other reasons to use FHA, but long term, it does make sense to pay these loans off or refinance them. Or a lot of people will buy a home with an FHA loan, will buy their starter home with this type of a loan. And then when they sell it, they'll go to conventional, put a little more money down. So anyhow, but that's what you need to know for mortgage insurance. So let's talk about why FHA is really cool, right? Separate and apart from making homeownership more affordable and being more lenient with a lower down payment and a little bit more credit blemishes, you can invest with an FHA loan. Now, you cannot buy an investment property. So don't go like, Linda, you're talking nonsense, but you actually can invest with it. And here's what I mean. There's this term called house hacking. I don't know who came up with it, but I'm going to trust that that's what this is called. But if you want to buy a 2, 3, or 4 unit property, you can buy that with an FHA loan, so long as you're living in one of the units. Okay. So remember, the primary purpose of the property is for you to live in it as your primary residence. But oh, by the way, there happens to be a couple extra units attached to it, right? That's awesome. Well, you can't live in all of them at the same time. So you actually legally can rent those other units out. Again, you've got to occupy one of them as your primary residence, but the other 1, 2, or 3 units you can rent out. Not only can you rent them out, so you're making income every month to offset your mortgage, in the pre-approval process, if we can document that rental income correctly, we can use up to 75% of it to offset your new mortgage to help you qualify. That is way cool. And all the while, if you have a 580 or higher, then you are going to be able to put that 3.5% down. So that's pretty amazing. You also can use FHA as a move-up strategy. Instead of buying your first house and selling it when you're ready to buy the next one, a lot of investors start this way. They'll just keep that original house. So after a year, maybe more, but at least live there a year. So it's legitimately your primary residence, and then the lenders won't grief you. But you could come back and say, Linda, I'm ready to buy another house. And I'm like, awesome. What are we doing with 123 Main Street that you bought a year ago? I'd like to keep it. I'm going to turn it into a rental property. And I have saved enough money to buy the next house. Great. And so you can, after 1 year, you could move up, get a bigger house or different part of town or whatever, retain the original property with that FHA loan attached to it, and you're totally compliant. So this is a really cool benefit. And if you've ever wanted to be an investor, this is a great way to get started. All right, so how do you make application? Well, just like you would any other loan, honestly. So for me, I have an online application, or you can book a call for 15 minutes with me, and we can talk about if you're really ready and if this is the right step for you. And that's how I start. And then the documents that you're going to need, well, first of all, it's way easier if you just get my free Smart Homebuyers guide, because at the end is a list of all the documents that you need when you're applying for a home loan. So that's the easiest thing. But there are a couple things I want to talk about, because these are the ones that kind of bite you in the butt the most often. 60 days of bank statements. I love these clients I had earlier this year, but she loved to move her money around to all her bank accounts. And I told her, I said, and this is not her real name, I said, Susie, I don't really care what you do with your money, but if you keep moving it from this account to that account to that account, I'm going to need all of those bank statements, and I'm probably going to need some receipts or deposit slips or copies of what the money was. Or you can just leave it alone right here, and then in 30 to 60 days, when you find a house and we close on it, we'll just pull it from that account. Well, she has her system down. That's how she likes to do things. Every time she gets paid, a little goes here, a little goes there, and then they switch places. And it's like this shell game, because at the end of the day, it's all her money and it's all her accounts. But she did it her way. And when we went under contract, I needed like 7 different bank accounts because I have to show the paper trail. Okay. So know that we're going to ask for 60 days or 2 months of bank statements to show that you have the money for closing. And if you will please leave all of that money alone in one place, you will be so much happier, and it'll be just so much easier. I promise you. Speaking of those bank statements, if there are any large deposits, like 1% or greater than the loan amount, then we're going to be asking you what that's all about. Okay. And any non-payroll deposits larger than your paycheck. That was a mouthful. Basically, if you have any deposits that exceed what your paycheck is going into your bank account, we're also going to ask you to document that. So, like I said, my free Smart Home Buyers guide has the list of all the documents you need. But when it comes to your down payment, please don't play the shell game with your money. It's just so tedious, and I don't want you to have to do that. And if somebody wants to give you money as a gift or whatever, just have a conversation with me or the loan officer you're using, so we can help you do that in a much simpler and easier way. There are some other FHA highlights that I would be remiss to skip over. So let me just give you a little bit more info because this is meant to be the summary, right? I'm not going to spend 2 hours going into all of this. I don't even care about some of the parts, right? Unless it applies to your unique situation, some of the pages in the guide, we just never touch. But these are the topics that you guys care the most about. These are the things that I'm working through with my clients all the time. Student loans. A lot of my clients have come out of college, they're professionals, they're buying their first house, which is super exciting, but there are student loans on the credit report. And so there's, your student loans might be in deferment. Some of my clients are teachers, and if they work for the school system for so long, then they get paid off. So there's all kinds of different scenarios. I understand student loans, but basically we're going to use 5% of the outstanding loan balance or the monthly payment reported on the credit report. And there's kind of a reasonable test, and there's a lot more fine print. I have a whole grid that I look at when we're doing student loans, but just know that we are going to have to count some portion of that against you, even if you're not making a payment right now. Also, co-borrowers. You can have a non-occupying co-borrower. That's really awesome. So if you have a family member like mom, dad, kids, siblings, grandparents, aunt, uncles, the in-laws, the outlaws, right? If somebody wants to help you and co-sign on this loan so you can qualify for a little bit more, or maybe they have a little bit better credit and it just, works things out for you, that's fine. But at least one of the borrowers must live in the home as their primary residence. Most important thing with FHA is that it is for your primary residence, okay? That has to be your intent. All right, and let's talk about refis. Yes, you can do a refinance with an FHA loan. You may even want to refinance out of an FHA loan. So here's a couple things I want to tell you. You can do an FHA streamline refinance to a lower rate after 6 monthly payments are made. No income, no credit, no appraisal. It is FHA to FHA. And so right now we're in a market where we're all hoping for interest rates to keep coming down. And so if they do, great. You need to make 6 monthly mortgage payments, and then we can have that conversation again. But you could also refinance from FHA to conventional, right? You're going to need a little bit higher credit score to qualify for conventional, but it will allow you to remove mortgage insurance if you have 20% or more equity in your home. Okay. Removing mortgage insurance if you have more than 20% of equity in your home. So again, this is what I do for a living. And this is what I'm here to help you with. I want you to understand all of this. I want you to know things that you can ask questions about, we can have conversations about, but I don't expect you to go home and look at all your stuff and know exactly what you're supposed to do. So reach out to me, let me help you. Let's figure out what this means to you. So if you need more information, grab my free Smart Homebuyers guide. It's I promise you, it's really good and really helpful. Book a planning call with me and let me give you an FHA quote or other loan options, because you might be surprised. FHA is an incredible tool, but it's not the only tool. All right. So I hope you enjoyed this video. Thanks for hanging out with me. Let me know in the comments what other topics you want to hear about, and I hope you have an awesome day.